I need to share something with you about how big money predicts economic crashes, something that will fundamentally change how you understand market movements and protect your wealth. I'm George Soros. You may know me as the man who broke the Bank of England in 1992, making over $1 billion in a single day by betting against the pound. But what allowed me to make that trade wasn't just analysis, it was understanding the signals that institutional money sends before major market disruptions, and more importantly, understanding how those very signals create the disruptions they're meant to predict. Before we continue, I encourage you to subscribe to this channel. What I'm about to share challenges everything Wall Street wants you to believe about market prediction. Let me be clear, institutional investors, the so-called smart money, are not omniscient. In fact, they're often catastrophically wrong. According to State Street's institutional holdings data, these sophisticated investors held approximately 60% in equities at the peak of the dot-com bubble in 2000, then reduced to below 45% at the 2002 bottom-selling low. They repeated this pattern, holding 57% equities before the 2007 financial crisis, then dropping below 40% at the 2009 bottom again, selling low. For over a decade after 2009, they maintained defensive positioning while missing one of history's greatest bull markets. But here's what most people don't understand. Even when institutional investors are wrong about timing, their collective positioning creates reflexive feedback loops that can cause the very crashes they're trying to predict or avoid. Markets are always wrong. The question is, by how much? And institutional investors, despite their resources and expertise, operate with the same imperfect understanding that afflicts us all. This is the human condition. We cannot escape our fallibility. What I'm going to show you is not a crystal ball. It's a framework for understanding the signals, the VIX spike patterns, the smart money flow index divergences, the options positioning, the credit spreads that reveal when the boom-bust cycle is reaching its inflection point. More importantly, I'll show you how these predictions themselves alter the reality they're attempting to forecast. By the end of this video, you'll understand how to read the institutional footprints in the market, and critically, how reflexivity makes crash predictions self-fulfilling prophecies. You'll learn why the institutional apparatus often fails, and how you can think more clearly about crash risk than even the largest hedge funds. Let me start with what institutional investors actually monitor. Unlike retail investors who follow CNBC and check their portfolios weekly, hedge funds and large institutions employ an entire apparatus of indicators designed to forecast economic crashes. The VIX, the fear gauge, the SIBO volatility index, measures expected 30-day volatility based on S&P 500 options pricing. When the VIX is below 20, markets are calm. Above 30 signals stress. Above 40 means crisis. Above 60 indicates panic. As of January 2026, the VIX sits around 15, remarkably calm given the turbulence we've experienced. But let me provide context. In April 2025, during the tariff crisis that President Trump triggered on Liberation Day, the VIX exploded to 60.13 on April 7, a level not seen since the pandemic crash of March 2020, when it reached 82.69, or the 2008 financial crisis peak of 80.16. The April spike took only 5 days to materialize, then normalized within 2 weeks as Trump walked back the tariffs. But here's what they don't tell you. The VIX doesn't predict crashes, it reflects the cost of insurance. When everyone rushes to buy protection, the VIX spikes. This is reflexivity in action. The scramble for hedges reveals fear, which validates more fear, which drives more hedging. The indicator and the reality it measures are not independent, they influence each other. Smart money flow index. This indicator, developed by Don Hayes and featured on Bloomberg terminals under Smart Index Go, tracks when institutional money enters versus when retail dumb money trades. The theory: institutions trade in the last hour when they have information. Retail trades emotionally at the open. The SEMFI successfully warned before the 1987 crash, the 2000 dot-com bubble, and the 2018 correction by forming negative divergences with the Dow Jones Industrial Average. These divergences occur when the market makes new highs, but the SEMFI fails to confirm, suggesting institutional investors are selling into strength while retail investors chase momentum. But I must tell you, the distinction between smart and dumb money has blurred considerably. In 2025, retail investors demonstrated remarkable sophistication. During April's tariff-induced sell-off, when the S&P 500 fell nearly 10% and institutional investors reduced their equity exposure, retail investors bought a record $3 billion in net equities on April 3rd alone. They bought the dip when institutions fled, and they were right. The market rallied over 35% from those lows by year-end. This taco trade, Trump always chickens out, proved more profitable than institutional caution. The yield curve, an inverted yield curve when short-term rates exceed long-term rates, has preceded every recession since 1970. The 2-year versus 10-year Treasury spread is the most watched pairing. The yield curve inverted in 2022 and remained inverted for months, yet as of early 2026, the long-anticipated recession has not materialized. The lag time between inversion and recession typically ranges from 6 to 24 months, but this cycle has proven exceptional. Here's the reflexive element. The yield curve inverts because institutional investors flee to long-term bonds, anticipating recession. Their actions help create the credit tightening that causes the recession they fear. The cognitive function, their attempt to understand economic reality, becomes the participating function that shapes that reality: credit default swaps and high-yield spreads. When the cost to insure against corporate defaults rises, institutions are pricing in higher bankruptcy risk. Credit default swaps on corporate debt and the spread between junk bonds and treasuries widen dramatically before crashes. These instruments represent pure reflexivity. Higher insurance costs make borrowing more expensive for the companies being insured, increasing their actual default risk. The act of hedging against corporate failure makes corporate failure more likely. Call ratios and options positioning. The skew index measures out-of-the-money put options, the black swan indicator. When it exceeds 150, institutions are heavily hedging with puts, expecting tail risk events. But remember, these hedges are expensive. Institutions can't maintain maximum protection indefinitely. Often, the crash comes when they reduce hedging due to cost exhaustion, precisely when they've been conditioned to drop their guard. Now I must explain something crucial that differentiates my approach from conventional market analysis. The act of predicting a crash changes the probability of the crash occurring. This is reflexivity at its most powerful, and it's why institutional crash predictions so often become self-fulfilling prophecies. The self-fulfilling prophecy. When large institutional investors believe a crash is coming, they take protective actions, selling equities and moving to cash, buying put options for protection, reducing leverage and risk exposure, rotating to defensive sectors. These individual decisions, multiplied across trillions of dollars, create the selling pressure they anticipate. According to State Street's institutional holdings data, as of October 2025, institutional investors pushed their equity allocation to 55, the highest since the global financial crisis. By November 2025, this had dipped slightly but remained elevated. Compare this to the defensive positioning institutions maintained throughout much of the 2010s, when they missed massive gains while waiting for a crash that never came. The pattern is clear. Institutions buy at peaks, sell at bottoms, and attribute their losses to market irrationality rather than recognizing their role in creating the volatility they fear. Historical pattern: the smart money wasn't so smart. Let me show you data that should humble any institutional investor. State Street tracks the actual positioning of long-term institutional investors across asset classes. The record is damning. 2000, institutions held approximately 60% equities at the dot-com peak. 2002, reduced to below 45% at the market bottom, sold low after buying high. 2007, back to 57% before the financial crisis, bought high again. 2009, below 40% at the market bottom, sold low again. 2010 to 2019, maintained defensive positioning, missing most of history's longest bull market. 2025, finally approaching pre-crisis allocation levels. This is the exact behavior pattern. Everyone criticizes retail investors for executing, yet institutions, with all their sophisticated models, Bloomberg terminals, and billion-dollar research budgets, did precisely this. The April 2025 case study: retail beats institutions. The April 2025 tariff crisis provides a perfect natural experiment in market timing. On April 2nd, President Trump announced sweeping tariffs, a 10% baseline on all imports plus higher reciprocal tariffs. The S&P 500 plunged nearly 10% over 2 sessions. The VIX spiked to 60.13. J.P. Morgan raised its recession probability from 40% to 60%, with chief economist Michael Feroli projecting GDP contraction. How did institutions respond? State Street's data shows they reduced equity exposure by 0.3% in April, allocated more to bonds, and surprisingly drew down cash reserves. Their risk appetite index sat completely balanced, neither buying nor selling aggressively. How did retail investors respond? They bought $3 billion in net equities on April 3rd as the market crashed 5%. They bought another massive amount on April 4th as it fell 6% more. Total retail inflows in the first half of 2025 reached $171 billion, the largest since Vanda Research began tracking in 2014. Who was right? By late June, the S&P 500 hit fresh record highs. The index rallied over 35% from the April lows through year-end. Retail investors who bought when institutions were cautious captured extraordinary returns. The institutions had the sophisticated models. They had the historical data. They had the smart money flow index and the credit default swap spreads and the VIX futures term structure. Retail had one thing: the understanding that Trump's tariff threats were negotiating tactics, not permanent policy. They intuitively grasped the reflexive dynamic. That extreme positioning creates its own reversal. Current reflexive dynamics. As of January 2026, we're witnessing fascinating contradictions that reveal the power of reflexivity. VIX at 15, remarkably low, suggesting complacency. Institutional equity allocation, 55% per State Street October data. Historically elevated recession probability. J.P. Morgan currently estimates 40%, down from 60% in April. Market concentration. The Magnificent Seven: Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, Tesla represent approximately 34-37 of S&P 500 market capitalization, the highest concentration since data collection began. Retail investor participation, record levels, with 62% of Americans owning stocks. Economic policy uncertainty index, at the highest level since 1985. exceeding even World War II and Great Depression levels by some measures. What's the misconception driving current dynamics? It's the belief that AI-driven earnings growth justifies unprecedented market concentration and valuation premiums. Investors believe technology companies have discovered permanent competitive moats through artificial intelligence. This conviction sustains equity allocation despite obvious risks. When this misconception collides with reality, and it will, the adjustment will be reflexive and violent. Not because the technology isn't real, but because the positioning has become too crowded, the expectations too elevated, the feedback loop too positive, the threat too open society. What concerns me most extends beyond financial markets. When institutional crash predictions become political weapons, they affect consumer confidence, business investment decisions, electoral outcomes, and central bank policy. These effects feed back into the economy, creating the conditions for the predicted crash. This is how economic crises can threaten democratic institutions, a pattern I witnessed firsthand in my youth. The breakdown of economic order creates the conditions for authoritarian solutions. This is why I focus not just on profitable trades, but on systemic stability and the preservation of open society. Based on my analysis of institutional indicators through the lens of reflexivity and fallibility, here's where we stand in the boom-bust cycle. The macro context. The Federal Reserve has been navigating between controlling inflation and supporting growth. J.P. Morgan's current recession probability sits at 40%, down from 60%. During the April tariff crisis, but still elevated above the historical average of approximately 10-15. But as I've learned over decades, central banks operate under the misconception that they can fine-tune the economy. They influence trends but cannot prevent reflexive boom-bust processes. Their very attempts at stabilization sometimes amplify instability, systemic vulnerabilities. Let me identify the most significant structural risks. Based on current data, 1. Concentration risk. The Magnificent Seven stocks represent 34-37 of S&P 500 market capitalization. This is higher than the 24% concentration of the top 10 stocks at the peak of the 1999-2000 technology bubble. However, and this is critical, today's concentration is supported by actual earnings. The Mag 7 contribute approximately 30% of S&P 500 earnings, compared to under 20% in 2000. The current P/E ratio for the top 10 stocks is 31 versus 21 for the rest of the market, a 48% premium. In 2000, it was 43 versus 21, a 105% premium. This suggests the current concentration is less speculative than the dot-com era, but concentration itself creates fragility. When rotation begins, narrow leadership can quickly reverse into broad-based selling. 2. Valuation metrics. While I don't place enormous faith in valuation metrics for timing, markets can remain irrational. Longer than you can remain solvent, they indicate the extent of the boom phase. Current elevated valuations don't predict crashes, but they determine severity when misconceptions correct. 3. The macro market disconnect. Here's a genuine anomaly. The Economic Policy Uncertainty Index reached the highest level since 1985, surpassing uncertainty during the Great Depression by some news-based measures. Yet the VIX sits at 15, indicating low financial market volatility. Historically, when policy uncertainty is extreme but financial volatility is low, the gap eventually closes, usually through a spike in financial volatility rather than a decline in policy uncertainty. 4. Debt and leverage. Corporate debt to GDP ratios remain elevated. The financial sector, particularly non-bank financial institutions, carries leverage that creates systemic vulnerability. The International Monetary Fund has highlighted these vulnerabilities repeatedly, reading the institutional signals through reflexivity. Current institutional positioning shows smart money flow index, no major divergences currently, suggesting institutions remain aligned with market direction. VIX term structure in contango upward sloping, indicating low near-term fear. Credit spreads relatively tight, suggesting confidence in corporate creditworthiness. Put or call ratios not at extreme levels. Institutional equity allocation at 55%, historically elevated, indicating significant exposure to downside risk. In reflexive terms, we appear to be in stage 5 or early stage 6 of the boom-bust cycle. Underlying trend begins. AI revolution, technology transformation. Misconception develops. AI guarantees permanent competitive moats. Boom trend and misconception reinforce each other. 2023 to 2024 reality tests the trend. April 2025 tariff crisis. Trend survives test. Conviction strengthens. Recovery from April through December 2025. Reversal and collapse approaching this stage. The April test strengthened conviction. Institutions and retail both learned that crashes get bought. This learning creates the conditions for the real crash, the one that comes when everyone expects it to be bought, but it isn't. What this means financially, for perspective: if markets correct 20% like the historical average recession drawdown, someone with a $500,000 portfolio would see $100,000 disappear. Recovery typically takes 18 months. But if institutional crash predictions prove prescient and we see a deeper 35-40 correction driven by deleveraging and concentration unwinding, losses would be 175,000-2,000, with recovery potentially taking years. The question isn't whether a crash will come. Boom-bust cycles are inevitable. In financial markets driven by imperfect understanding, the question is, are we near the inflection point where the misconception meets unmovable reality? Let me give you practical guidance, informed by institutional methods but improved by understanding reflexivity and fallibility. First, understand what you're actually seeing. When you hear institutions are defensive, ask yourself, is this creating the crash they predict through reflexive feedback? Are they early, as they were throughout 2010 to 2020, missing years of gains? Or are they capturing a genuine systemic vulnerability? Use multiple timeframes, short-term, monitor VIX and smart money flow index for divergences. Medium-term, watch yield curve, credit spreads, institutional allocation data. Long-term, track debt levels, systemic leverage, concentration metrics. Second, don't blindly follow institutional positioning. The data is unambiguous. Institutions bought at the 2000 peak, sold at the 2002 bottom, bought at the 2007 peak, sold at the 2009 bottom, and maintained defensive positioning that missed most of the 2010s bull market. Their track record is poor. Better approach: use institutional indicators as one input, not the primary signal. Recognize your own fallibility. Remain open to disconfirming evidence. Adjust as new information emerges. Don't anchor to initial predictions. Third, portfolio actions based on current cycle stage. Given that we're likely in late stage 5 or early stage 6 of the boom-bust cycle, reduce leverage aggressively. Leverage amplifies losses during reversals. Trim concentrated positions in Magnificent 7 if they represent 35 of portfolio. Increase cash allocation gradually to 15-20, giving you dry powder for opportunities. Consider put options on broad indexes for asymmetric protection. Maintain quality. Bias toward companies with pricing power, low debt, real earnings. Don't panic. Sell everything, but recognize that when misconceptions correct, the repricing is swift and brutal. Fourth, specific monitoring checklist. Track these weekly. VIX level and trend watch for sustained moves above 25. Smart money flow index divergences from major indexes. 2 years versus 10 years. Treasury yield spread. High yield credit spreads widening signals stress. Institutional equity allocation. State Street monthly reports concentration metrics for top 10 stocks. 5th, the civic responsibility beyond personal portfolios. Support policies that reduce systemic risk. Higher capital requirements for financial institutions. Limits on leverage in non-bank financial sector. Transparency in derivatives markets. Central bank independence from political pressure. Oppose market fundamentalism that claims markets are always efficient and self-correcting. Systemic risk doesn't require regulatory intervention. Crashes are healthy, unpredictable, and unavoidable. Remember, institutional crash predictions affect real people, real businesses, real communities. When institutions position defensively, they reduce business lending, which reduces hiring, which reduces consumer spending. The prediction helps create the recession. This isn't just a trading game with abstract consequences. Let me conclude with what decades of predicting crashes has taught me about the institutional apparatus and the nature of market reflexivity. The institutional tools for crash prediction, the VIX, the yield curves, the credit spreads, the smart money flow index, these have value, but only if understood through the lens of reflexivity and fallibility. Institutions are not smart money with perfect foresight. They are participants in a reflexive system where their predictions change outcomes. Their sophisticated models cannot escape the fundamental problem. They're trying to predict a system they're actively changing through their participation. The data I've shared is damning. Institutions bought at peaks in 2000 and 2007. They sold at bottoms in 2002 and 2009. They missed most of the 2010s bull market while waiting for a crash. In April 2025, retail investors who bought when institutions turned cautious captured a 35% rally. The track record of smart money is demonstrably inferior to informed retail investors who understand reflexive processes. The real insight transcends market timing. Crashes emerge from boom-bust cycles driven by misconceptions that become temporarily self-validating through reflexive feedback loops. Right now, the key misconception is this: that AI-driven earnings growth justifies unprecedented market concentration and that the Magnificent Seven have discovered permanent competitive advantages. This belief is sustaining institutional equity allocation at the highest level since the global financial crisis. When this misconception collides with reality, regulatory challenges, competition, margin compression, or simply valuation gravity, the adjustment will be reflexive and severe. Not because AI isn't transformative, but because the positioning is too crowded, the expectations too elevated, the concentration too extreme. But we have agency. We can read institutional signals without blind faith in their predictive power, recognize reflexive feedback loops that make predictions self-fulfilling, position for volatility while avoiding panic, protect ourselves, and advocate for systemic reforms that reduce crash severity. My conceptual framework of fallibility and reflexivity has guided me through every major crisis since 1987. It helped me understand not just when crashes might occur, but why institutional predictions so often miss the mark. The future is uncertain. We cannot escape our imperfect understanding. This is the human condition. Crashes will come. They're inherent to boom-bust cycles in markets driven by human psychology and herd behavior. But understanding how big money attempts to predict them gives you a critical edge. The knowledge that their predictions are part of the reflexive process they're trying to forecast. Use this knowledge wisely, protect your wealth, but more importantly, work toward a financial system with proper regulatory guardrails that prevent catastrophic boom-bust cycles from threatening the open society itself. Markets left to their own devices do not self-correct, they amplify. This is not ideology. This is observable reality. The institutional investors have their models, their Bloomberg terminals, their vast resources. You now have something more powerful, understanding of reflexivity and the recognition that imperfect understanding theirs and yours is not a weakness to hide, but a reality to embrace. There is no shame in being wrong. The shame lies in failing to correct our mistakes. Thank you for watching.